Welcome to the Deloitte Debrief Tax webcast series in Asia Pacific. Our webcast today is from our transfer pricing series and is titled Navigating Intra-Group Service Challenges in Asia Pacific. My name is Samuel Gordon, and I'm a tax partner based in Deloitte, Japan, Tokyo office. I have the pleasure of hosting today's webcast. I have four speakers with me today: Chris Ng, Anisha Jagannathy, John Lately, and Vishang Sheth. Chris is a tax partner based in Deloitte South Korea Seoul office. Anisha is a tax director based in the Deloitte India Mumbai office. John is a tax senior manager based in the Deloitte China Shanghai office. And Vishang is a tax director based in the Deloitte Malaysia Kuala Lumpur office. You may access our bios on the left side of the screen. Before I introduce today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First off, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons on the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the surveys on screen. Thirdly, if you require an attendance record for this event, you can download your CPE certification by clicking the Request CPE icon at the bottom of the webcast content. Now, before explaining the agenda, I'd like to lay out a few drivers as to why we thought this topic was of particular interest to our clients at this time. The first is, we know that this topic and the amounts involved are typically very material to our clients, and they are what we consider, or what tax administrations in the region consider, low-hanging fruit. Second, the 2021 Deloitte industry outlooks for various financial services sectors drive home the financial and commercial importance of this topic, in not just the tax aspect of it, and particularly with respect to changing operating and financial management models. For example, the banking outlook highlights the increased adoption of contactless technology with the client digital experience accelerated, whereas our insurance outlook put a emphasis on expense management, and these types of issues are the types of things that MNCs can't really deal with on a decentralized manner. Increasingly, these need to be dealt with from a central perspective, and with that centralization, it places more importance on intergroup service models and the tax deduction of intergroup charges. So against this backdrop, today, we'd like to cover several topics. The first, we'd like to start off by discussing the current environment, and that is, we want to talk a little bit about the low added value services versus not low value added services. We'd also like to talk a little bit about audit trends, both from a tax and regulatory perspective from across the region. We'll then talk about some of the trade-offs that firms face, as this typically frames the design and the evaluation and the operations of intragroup service models. And then we want to take a deep dive into some of the lessons from across the region. In that, we'll look at indirect taxes, we'll look at accounting and service categorization, we'll look at benefit tracking, and finally, we will look at documented defend models. Our objective is to leave you with a better understanding of some of the practical options to consider when you're strategizing on ways to address deductibility issues and operating models for these types of services in the region. So with that, I'd like to if we could turn to the next section, the current environment. With respect to the current environment, let's start with a snapshot of where we are 5 years on from the OECD's attempt to get a consensus on low value-added services and the challenges that we have when dealing with not so low value-added services. Anisha, can you take us through this area, please?
Thank you, Samuel. Historically, organizations have been facing challenges in relation to their group charges. Tax authorities around the world have expressed skepticism that these charges are eroding their tax base and have questioned the intent behind these charges. With the objective of addressing this controversy, OECD released the Action Plan 10 on low value adding services, which provided countries with guidance to develop their transfer pricing rules to protect themselves against common based eroding payments such as management fees and head office expenses. For this purpose, guidance defined what really would be low value adding services, which are supportive in nature, which are not core to the business of the group, that do not require use or creation of any unique and valuable intangibles, and do not involve assumption and control of any tax risks. Therefore, services such as accounting, HR, legal, tax, IT, non-core IT would likely to meet the definition of low value adding services. The guidance also specified services that would not qualify as low value adding services, with the likes of R&D, financial transactions, marketing support services, etc. In addition to defining these services, the guidance set out an elective simplified approach for determining the ALP for such services, including a simplified benefits test. The guidance recommended documentation and reporting requirements that should be met by groups electing for this simplified approach, thus providing a comprehensive guidance for such services. The charges for these low value adding services include both direct and indirect charges. Indirect charges involving cost allocations are much more common than the direct charges. From an ALP perspective, the guidance specified a safe harbor markup of 5% for these low value adding services. We now take a 5-year leap from the release of the guidance and provide an overview of the recent trends we are seeing across Asia and in other regions. Globally, there has been no consensus among countries on the guidance for low value adding services, and the members of the inclusive framework were not mandatorily required to adopt it. As a result, the guidance has not been implemented in its entirety by most of the countries in Asia. In the past 5 years, the entire global business environment has seen dramatic changes. For example, there has been a renewed focus on technology. Currently, multinationals are spending millions of dollars on technology upgradation and digitization. Investments are made centrally for the benefit of all group companies. Where does one draw the line between low value adding services and the core business? Is digital transformation a part of core business? For the new age fintech businesses, what role does technology play? For digital platform payments, for mobile wallets, would technology be core or non-core? In our experience, the gap between technology-enabled and non-technology-enabled businesses is slowly diminishing. Also, in the current times, questions are raised on the spend required for remote operating models and other IT projects. How should these expenses be viewed? Thus, today, there is a greater need for organizations to analyze their current business operations to identify what services would qualify as low-value-adding services vis-a-vis what would be core to their business. With respect to the markup also, we've seen divergent approaches being adopted in different countries. There is a lack of alignment between service providers and service recipients. Service providers do not regard their services as low-value-adding, while service recipients think otherwise. This leads to an inconsistency of markup across different jurisdictions for similar services. For example, in India, for receipt of low-value-adding services, the safe harbor provisions have been introduced with an agreed markup of 5%. However, this applies only to receipt of services, and provision of low-value-adding services is not covered. When India provides low-value-adding services, they need to be remunerated with an arm's-length markup, which is practically much higher than the 5%. Similar trends are also seen in other countries in the APAC region. Thus, there is an inconsistency in what a country expects to charge and what it agrees to pay for similar services. I'll now request Chris to provide us an overview of the current audit environment.
Thank you, Anishri. Thank you. Yes, it's certainly worth a while to see how the audit environment for intra-group service has changed across the Asia-Pacific region since the release of OECD's guidance on the low value-added services. For example, in Korea, Korea has adopted the low value adding services into its legislation in 2020, and we certainly anticipate less administrative burden throughout the application of the simplified approach, which allows the same 5% markup as an arm's length charge. The law also set out a threshold to exclude services from low value adding intragroup services, regardless of the nature of the services, whose charge out exceeds the lesser of 5% of sales and 15% or 15% of operating expenses of the service recipient. It does not qualify as a low value added intragroup services. Therefore, it just falls under the category of general value added services. Therefore, should follow the current existing deductibility requirements. Now, many tax authorities in Asia tend to view the payment of intragroup service fees as an outflow of money from the country to another foreign country, and have been very, very aggressive towards the deduction of such fees. And in Korea, it was actually not uncommon to see a very negative coverage of such a payment, excessive payment made by the multinational companies doing business in Korea, and which includes major inbound financial institutions. After several years of collecting now the BEPS documentation, the master file and local file, the Korean tax audit teams and have now unprecedented, and I'm sure it's similar across the region, unprecedented access to taxpayers' information, and they have more opportunities to take aggressive audit positions, especially in the areas of service fee. As such, the low profitable or money-losing inbound companies are now more vulnerable than ever as targets that the audit teams strongly attribute the low profitability to the excessive service fee payment out of the country. Now, in order to deny the deductibility of intragroup service fees, the authorities tend to focus on testing whether the services provided were economically beneficial to the service recipient, and they tend to narrowly interpret the relevance between the intragroup service provided and the business operation of the service recipient, while being very, very generous towards treating the services as a shareholder or stewardship activities. The auditors will often request very, very detailed information, such as the entire calculation, allocation flow of intragroup service fees, detailed individual evidence linked to every service that's been rendered and received, which makes the taxpayers they're very difficult to prepare, and it requires a very lengthy discussion with the service providers in order to prepare all the necessary documents. Now, I'll hand over to Rushan to see how other countries view these intragroup service payments from a regulator's perspective. Rushan?
Thank you, Chris, on the information about the current audit environment and the developments in that regard. Now, in the same context, now let's look at certain regulatory trends surrounding intragroup service payments. The regulators, consisting of central banks and foreign exchange control authorities of various countries, do keep a very, very close eye on payments made by the service recipients. The intention here is to curb the foreign currency outflow, and it has been observed that the regulators do fall back on transfer pricing to make necessary checks. Let us look at two examples from Southeast Asia, that is Malaysia and Vietnam. In Malaysia, the central bank, that is Bank Negara Malaysia, required the statutory auditors to carry out certain specific assessments in relation to intercompany charges paid to foreign-related entities by the local financial institutions. Though this requirement was retracted after a couple of years in force as a mandatory annual assessment, but this still remains as a request-based assessment. The statutory auditors were required to perform the following and issue a certificate to the board to enable the board to make a decision on the arm's length nature for the payments. The activities which the statutory auditors required are as below. Verify whether the agreements are available for all service charges, validate the accuracy of the amount payable, ensure services are performed, ensure the charges are commensurate with benefits received and are not arbitrary reallocation, ensure that the services are directly beneficial, ensure that the charges are appropriately accounted for and adequately disclosed. In assessing the benefits test, the statutory may and would generally place reliance on existing transfer pricing reports. The following are some of the examples of documentation requirement on the benefits test which are expected to be maintained by the service recipient. Proof of provision of intra-group services, detailed description of benefits received by each business unit, documentation which includes correspondences, memos, manuals, and directives indicating a benefit to the recipient of the services, job descriptions of staff of both the service provider and service recipients to prove that there is no duplication of services, documentation demonstrating that the recipient's operations have not been made to absorb a disproportionate share of the total regional or global costs of administration and management. Focusing on Vietnam, this is a practical case which is faced by us. Though the Vietnam regulator does not require a certification exercise unlike Malaysia, the level of inquiry and documentation is similar. The regulator asked specific questions on benefits accruing to the recipients and the demonstration of provision of specific services by the service provider. The regulator conducted a thorough audit, keeping in perspective each service category and mapping the services to the service agreement. The management was required to come up with extensive details on benefits, cost allocation, as well as evidences on rendition of services. This entire exercise was not only time-consuming and expensive for the client, but also eventually resulted in double taxation. The overall learning from this and the previous discussion of Chris is that the taxpayers need to have a thorough TP documentation along with internal documentation to evidence benefits and need for the service recipient. With this, let me pass back to Sam to take us through the first polling question. So Sam, over to you. Chris, do you want to take this question? I think Sam is on mute.
It seems to me we have some technical difficulties with Sam. So the polling question, the first one, if your organization has faced a controversy in relation to intra-group charges, what has been your approach to address this issue? The first one, the voluntary adjustment. Second one, the reevaluate the group policy. Third, modified group policy after facing adjustment and audit scrutiny. Fourth, the MAP proceedings. Fifth, APA, and the last, don't know, not applicable. So while the audience is tackling this polling question, initially in Japan, Singapore, and Hong Kong, several of larger APIC financial service hubs, we don't see clients taking these types of transactions to APAs, given that they are multi-party transactions. Are you seeking something different in India, and if so, why?
In the initial years of the APA regime in India, several Indian service hubs providing services to group companies globally, especially IT/ITES services, did sign up for the APA program. For the first few years, there was a focus on unilateral APAs, which was subsequently followed by a trend of applying for bilateral APAs. Given that these are multi-party transactions, over time there was an informal understanding with the APA authorities in India that the APA approach, which was agreed unilaterally or under a specific bilateral APA, with a specific jurisdiction would be followed for transactions with all other countries if the services remain the same. This gives significant comfort to the clients to achieve certainty through APAs, even for multi-country transactions. More recently, Indian subsidiaries and branches receiving intra-group services have also started to approach APA authorities. There have been a couple of successful cases wherein authorities have adopted a pragmatic approach and agreed for specific parameters under the APA terms, vis-a-vis the earlier subjective receipt and benefits test. At the back of this approach, we are now seeing many more clients opting for the APA route for receiving inter-group services as well.
That's a good news, Anishri. Do we have the result? Are you back, Sam?
Yes, apologies. Some sort of technical difficulties there. I am back, and I do see the results there. And it's interesting. As we thought initially, the APAs are not particularly common, but it's interesting that to note that groups are obviously reevaluating their policies, subject to controversy. So there's probably a lot of adaptation over time with policies. And I think, interesting enough, I think that feeds in probably, John, into the next section that we're going to speak about. If we could turn to the next slide, please. In this section, we want to talk about the trade-offs that firms face. And as noted, if have gone through controversy and you're reevaluating or you're redesigning or you've made changes to your organization and you're redesigning the transfer pricing around this area, there are a lot of technical dimensions to consider. And as we noted, APAC is such a broad jurisdiction or region in terms of the number of jurisdictions. So the starting point for this is often navigating, prioritizing, and strategizing. And so John is going to walk us through some of the key priorities as well as give us a sense of how to navigate some of the technical dimensions of the countries. John, can I turn to you?
Sure. Thanks, Sam. So service fee arrangements, regardless of industry, have always required compromise, as people will understand. It requires that balance between the competing interests of stakeholders, internal and external. Now, when business plans to set up new service outsourcing arrangements, it's very important to balance the interests of those stakeholders and how this will impact the TV policies that are being adopted. And this is particularly, as Sam said, where you are looking at services provided across regions. So Asia Pacific, there's a wider range of trade-offs than you might get in the European Union or the Americas, just because Asia Pacific is such a broad geographic area in terms of regulatory and economic conditions. So on this slide, we have set out several of the key considerations as part of setting up new service arrangements or revising existing arrangements. So first, it's critical to understand commercial and business drivers behind the changes. So there are a wide range of potential commercial drivers, shifts in corporate strategy, greater emphasis on cost control, plans to decentralize or even to decentralize services, and increasingly the need to further embed digitization of service delivery through artificial intelligence or robotic process automation. Now, being clear on the commercial drivers ensures that they won't be overlooked as policies are developed, and ensures that they can be documented and then explained to tax authorities in the future, justifying the reasons for that change and generally why it's been done. So for the financial services sector, we looked at point number 2. So FS regulations may impose significant restrictions on outsourcing and cross-border payments as well. So there are the wide range of jurisdictions once again, and there is a lot of divergence in FS regulation. So accordingly, the impact of those regulations needs to be taken into account by both the commercial teams who are setting up the arrangements, as well as the tax teams who are going to work with the policies and actually implement things. So a key consideration for tax is going to be how the different bundles of services that are provided, how these are going to be managed, and ensuring that reasons for differences between countries or sort of subclusters of jurisdictions can be clearly distinguished. That's for the regulatory purpose as well as transfer pricing and tax. So a third point is one that taxpayers are increasingly focused on, and That's really about the process of calculating the service fee, and that the process is of increasing importance, and really it is key. So when service arrangements are being entered into, or where existing ones are being revised, the typical advisory or transfer pricing policy report that supports that change shouldn't be viewed as the finished product. Rather, it's a policy document which should be supported with a clear process for the ongoing calculation of service fees and for the identification of benefits. Now, people will be aware that there's often a fixation on service fee markups. And so, whereas the identification of the benefits provided and the costs, arguably there's actually a lot more risk in that area because there's a lot more cost in the cost rather than in the markup. So having a clear process that can be easily replicated year by year and that can be documented helps form that first clear line of defense in investigations and allows those trade-offs that you've taken through the commercial, the regulatory perspectives to be quite clearly explained. Now, this leads to the final point here, and that's the question of how do taxpayers actually make decisions about those trade-offs and which factors should they prioritize. So now our view is that tax teams need to identify common denominators across commercial, regulatory, and foreign exchange and tax considerations. So if we move to the next slide, this shows the results of some Deloitte surveys on various commercial, regulatory, and tax considerations that service providers and the teams developing rules will need to consider across a number of jurisdictions. And so for the purpose of today, we've shown the countries represented from our presenting team. And this type of approach helps to identify jurisdictions that will need to have their own specific treatments and which ones will need to stand apart from a routine process. So from this list of jurisdictions, you can see quite clearly that there is a key outlier in terms of the financial regulators, which is Malaysia in this situation, as Roshang was referring to earlier, whereas most of the other factors are fairly consistent across jurisdictions. There are some tax differences, but broadly the picture is the same. And if we move on to the next slide, we again can see some fairly specific outliers. So these need to be looked at specifically. So we've got Vietnam, again, as referred to before, with particular requirements. India is always known to be fairly litigative in terms of service fees. And then South Korea has its own particular requirements as well. So while some of these issues may seem straightforward, for example, such as with indirect taxes apply in all markets, and in this situation, all but one of the markets does have indirect tax, using it as an example, you do need to actually consider indirect tax implications on both inbound and the outbound service fees, potentially with different treatments between the two. So this simple issue actually does become much more complicated. And then other, even more complicated issues, such as whether transactions are cash settled or not, issues like that need to be addressed and managed across multiple jurisdictions. And so this type of approach, looking at all the different considerations and then bringing it down to common denominators, common factors to consider, helps you actually get across that line. So once you identify those common denominators across all the jurisdictions, taxpayers are going to be able to line these up more clearly with their commercial drivers and the applicable ETS regulations to build durable service policies and pricing arrangements. And with that, I'll pass back to Sam.
Thank you, John, and that's very helpful. So turning to our second polling question of the day, the question is, who are the key stakeholders in your organization when making decisions to implement or operate service fee or models on a regional or global basis? Does this sit primarily with tax, or is it primarily with tax and finance? Or thirdly, is it tax, finance, and the business that tend to be engaged in process? Or lastly, you don't know or is not applicable? I would note, to John's first point around the drivers and the dimensions, quite often when we look at these, who's involved as the key stakeholders in these types of arrangements, with respect to the third option there, the level of involvement on the business side typically is quite often correlated with whether or not the service fees themselves impact management reporting, right? If they're reflected on a management reporting basis, or if they're not. The business is important, and the service providers are important all the way around, but the level of interest in terms of the output from a project, and then the ongoing processes tends to be more involved, the more skin they have in the game from a management reporting perspective. So that's probably my observation. And we have some results here, and it's interesting. As it does see that most of our respondents, it does come down to tax finance and business being involved, and I imagine there's a number of factors there, but one might be what I just mentioned in terms of these types of charges being reflected for management purposes, and also just the need for information from business. Second is finance, and then it seems like as if it's not too rare that it's tax only, and I think that's correct in terms of what John was saying. That's what we would hope for in these types of setups. So with that, we want to now spend the rest of our time talking about the practical lessons from across the region. And what we have in mind here is to really give you some ideas on how to strategize and improve the models, or give thought to improving the models that you currently employ, as well as part of that, to start to think about this from a stakeholder, a resourcing, and operational trade-off perspective. Because as we mentioned, most of the time we think about it in terms of documentation or a very discrete project, when in fact this is very much more about a process over time. So with that, we'll start off with Prashant, who's going to walk us through some lessons from Singapore with respect to indirect taxes, and then we'll turn to transfer pricing lessons. Prashant?
Thank you, Sam. So let us now look at some interesting updates from GST guide on TP adjustment, which was issued in Singapore during November 2020, which explains the corresponding GST adjustments when TP adjustments are undertaken by companies. So let's look at the situation when an upward GST adjustment is required, when the TP adjustment results in an increase in the original price of goods or services. And this upward GST adjustment is possible when the TP adjustment is either effected through the financial statements, or the TP adjustment is taxable or allowable for income tax purposes. So to get it right, the upward GST adjustment needs one of these two conditions to be met. However, for downward adjustment, when there is a decrease in price of goods or services due to TP adjustment, both these conditions need to be met, which is the adjustment needs to be reflected through the financial statements, as well as such adjustment should be taxable or allowable for income tax purposes. So administrative concessions are provided for wholly taxable businesses are not required to perform any GST adjustments. For mixed suppliers, that is banks and insurers, only TP expenses that are not fully claimable will require GST adjustments. For TP charges to other entities where the supplier and the recipient can claim input tax would also not require any GST adjustments. Let's look at a few practical issues in application of this guide. So let's look at an example where the TP expense is charged by an overseas related company to a local company. The local company, as an example, let's say, would consume about 20% of the expense and recharge the balance 80% to its related parties. And this percentage of recharge will fluctuate month on month. So this 80% is more like an annual average, which is there. When the TP adjustment is determined at the end of the year, they would need to segregate the amount that are consumed by the local company, which is subject to GST adjustments, while the rest would not be subject to GST adjustments, assuming other related parties are fully taxable or are located overseas. Documentation issue is prevalent as TP adjustments are only done through the books. There will not be formal invoices which will be issued. but GST adjustments require corresponding invoices to be issued. So as seen in example 1, at 1 above, once the percentage has been determined for the TP adjustment, a new process to issue the credit note or debit note is required. As TP charges may be incurred or charged on a more consistent basis, whereas TP adjustments are only made periodically, the authorities would have provided the proxies to determine the basis of GST adjustment. The proxies, however, are not easily applied practically as the company may not have relevant information readily available. The authorities also require approval to use other proxies. So with this, now let's turn to Anushri, who will offer TP lessons on accounting and service categorization. This is from an India perspective and potentially leverageable across Asia Pacific. So Anushri, over to you.
Thank you, Prashant. Thank you, Prashant. Intra-group service charges have been a highly litigated issue in India on two fronts, first being deductibility of such charges and secondly from a transfer pricing perspective. Let us first discuss the deductibility issue. Indian subsidiaries or branches of foreign groups, similar to other group companies, have been receiving these intra-group services from their overseas offices and correspondingly receive a charge for these services. Under the Indian domestic income tax provisions, deductibility of these intra-group service charges is governed by Section 37 and 44C. Section 37 is a general category governing deduction for any business expenditure that is not capital or personal in nature and which is expended exclusively for the purposes of business or profession. And those expenses are deductible under Section 37. While Section 44C is a restrictive deduction for an Indian branch applying to a very specific category of head office expenses, which are in the nature of executive and general administrative. The section restricts deduction to a percentage of only 5% of the total income. This section and its restrictions apply only to specified head office expenses and not to general business expenses. Clients in India have suffered significant disallowances for these intergroup charges for several years. One of the main reasons has been insufficient information and documentation in relation to these services. Also, in absence of adequate information, they have not been able to differentiate between business expenses deductible under the general category, resulting in all kinds of charges being clubbed under the bucket of head office expenses, which are subject to the restriction of 5%. The consequential disallowances have significantly impacted profitability in India. From a transfer pricing perspective also, Indian tax authorities typically start with the assumption that these intergroup service charges are levied with the purpose of profit shifting, and consequently they determine the ALP for these charges to be nil. Therefore, satisfaction of the receipt and benefits test has been critical. Due to the subjective nature of these requirements, we've seen significant transfer pricing adjustments made for these charges in India. Both these issues, deductibility and determination of ALP, are based on the nature of the services and the availability of supporting information and documentation. Therefore, appropriate categorization and correct accounting treatment for these charges, in addition to maintaining the adequate supporting documentation, becomes critical from an India standpoint. And as Rishang mentioned, these principles apply in the region as well. We'll explain this through an illustration on the next slide. If you look at the left side of the left part of the slide, group companies have historically been receiving various kinds of services which were primarily in the nature of low value adding services, accounting, auditing, HR, legal, general administrative services, and non-core IT services. These were subject to local restrictions, but over time, organizations have expanded the nature of services provided centrally. And we've seen several different types of services being provided, such as technology platforms, digital applications, automation costs, marketing services, etc. Business teams to support their local counterparts. In the financial services industry, for example, Investment and banking teams across the globe provide support to their local teams, sometimes as subject matter experts, industry experts, or with geographical knowledge critical to a deal. Over time, when these new services expanded, the newer categories were typically clubbed with the existing intra-group services. From an accounting perspective also, the new services were mostly added as just another cost center under the original category of intra-group services. As illustrated, this led to a significant increase in the pool of intra-group service charges, which was subject to local restrictions. As a result, the Indian branch was allowed a deduction only to a limited extent of the total charges, and the balance and majority of the charges were disallowed. This practical approach of clubbing all the intergroup charges under one bucket has led to significant disallowances, in most cases over 50% of the total charges. As a way forward, organizations could consider an alternative approach in relation to these services. By undertaking a detailed analysis of the nature of intragroup service charges, they will be able to identify and separately categorize only those services which are in the nature of general administrative in nature. This could reduce the pool of charges subject to restrictions. This will result in differentiating the more core and complex services such as digital transformation, marketing, etc., that need to be evaluated separately. Additionally, charges in relation to revenue-generating services provided by overseas business teams should be separately recognized and tagged to their respective local profit centers, distinct from the general category of intragroup services. For example, charges for support from overseas investment banking teams should be tagged and considered while arriving at the overall profitability of the Indian investment banking segment and not as part of general overhead charges. With this approach, business expenses which can be substantiated to be incurred exclusively for profit-generating activities could be fully deductible under the general deduction category. With the exclusion of these specific services or business-related services, the general pool of the low-value-adding services will significantly reduce, which will further reduce the amount disallowed for the Indian entities. This can be achieved by setting up processes that will drive the appropriate categorization of these charges and provide guidance on the treatment and documentation requirements. For this purpose, technology can play a very critical role. Technology can help organizations effectively categorize these expenses, including implementation of the classification in the internal systems, and also create a repository of the required supporting documentation. Practically, certification of this approach by an independent third-party expert could also assist in substantiating the process of categorization, which will help in claiming a higher deduction and will also assist during tax scrutiny. This approach of appropriately categorizing and accounting for these service charges would also resonate with other tax authorities. I would now request John to offer some insights on benefit tracking, which is in fact the basis and support for the categorization approach I outlined.
Thanks, Janushree. So in recent work, we've been quite focused on emphasizing the benefit test as part of service fee projects. So in particular, working with clients to understand the spectrum of support that they're considering when they're looking at tracking benefits being provided across the region. So as you mentioned earlier, there is an increased focus on whether benefits have actually been received as part of service fees. Now, especially this is the case where you've got regional service centres providing wide, consistent ranges of services, which maybe are not directly linked to what the local entity sees. So now we like to view the options for benefit tracking along a spectrum. So moving from left to right, we start with benefits that are identified as part of an implementation project at the time of the change. So this is generally a one-off document that's prepared when services are just starting to be put underway or are not yet ready. Now, while this is a very good approach for something which is very project-based and specific, for ongoing services, the original planning report and the benefits will often be out of date relatively quickly, especially in areas where there are a lot of changes, what's going on, and where regulations are moving, changing what you can do. So increasingly common these days is the middle option, the periodic survey tracking approach. Now, this is where the benefits are identified and updated on a periodic base to ensure that they're up to date and helps to provide stronger support for the service fees. So this type of approach is undertaken both internally and with external support, and the results are generally able to be incorporated into contemporaneous local files and other specific documentation. Now, the far right hand of the spectrum covers the highly detailed analyses that are normally just prepared for jurisdictions with particularly onerous requirements, in particular regulatory requirements. Now, these require very detailed analyses and normally wouldn't be done on a cost-benefit type approach. So specific reasons, regulatory in particular, may require it, but normally you wouldn't be looking to do this. So when you're looking at a new service arrangement or a revision, it's quite important to consider where on the spectrum the business should be placed. For relatively simple back office services, the minimal approach may be quite suitable. But centralized service providers are providing a wide range of core and non-core services across the region do really need to look at the survey tracking option and further options to be really quite defended. So the position in the spectrum may depend on your perceived effectiveness of the approach. And generally, we view that the middle approach gives a initial and a secondary line of defense against tax authority queries. However, it's quite important to consider how resourcing will work. Will you be able to manage this within your existing team? Will you need additional support, whether internal or external? And that will actually have some impact on where you want to put yourself. Now, the final point here is just really, once you actually implement this, it's important that you validate its appropriateness from time to time. So making sure that you actually assess whether or not your current level of support is going to actually track the benefits appropriately, or whether some adjustment is required. And with that, I'll pass to Sam to talk through some specific examples.
Thanks, John. And on this table, on the next slide here, we have 3 tables that basically present some of the key points in taking what I would think of as a one-time benefit survey, maybe done on a project basis, to a periodic benefit tracking process or survey process. The first point I would note with the survey itself is that typically anything beyond 10 or 12 simple questions tends to get too long from a respondent perspective. So, the practicality of trying to get the right information, the most critical information in terms of from the survey, and keeping the respondents moved along and contextualized is part of that. The thing I would say in addition to that is one dimension that we find that helps with the operationalizing of this is that there's a change management aspect associated with this, and quite often we find that for implementing these kind of things, moving them from a project to a process, the sponsors are very important, right? Sponsors of the project who then become effectively sponsors of processes quite often. They can range from senior management in tax to senior management in finance to senior management in the business. And they help ensure that the stakeholders, many of them survey respondents, for example, are fully engaged in this. And the stakeholder roles are clearly understood and traceable by tax as an important way of making sure that the governance around this is appropriate. Finally, we have some indicative steps that are involved in the periodic surveying itself. I think this is relatively straightforward, but as John mentioned earlier, the process matters. And ensuring that you have the right folks involved in the process matters. So ultimately, that's what leads to the output that will inform your pricing model and your lines of defense vis-a-vis tax and financial regulatory administrations. So with this, I'd like to turn now to Chris, who's going to offer some lessons from a document and defend side from Korea.
Thank you, Sam. Let's now look at some effective ways to defend intra-group service charges and also get deduction for corporate tax purposes. Basically, it is very important that the service recipient identify and satisfy the local deductibility requirement to have the intra-group service fee to be recognized as an arm's length charge as well as a tax-deductible expenses. Now, in Korea, for example, you should have a service agreement executed prior to receiving the service from the service provider, and the service recipient should have expected benefit from the services received in the form of an additional revenue or a reduction in cost. Thirdly, the service fee incurred for the service itself should be computed according to the arm's length principle as set forth in the transfer pricing regulation. And lastly, but perhaps most importantly, you should have all the supporting documents substantiating all of the above, and that should be ready when the tax auditors then come in and scrutinize your service charges. Now, among these requirements, the auditors in practice often challenge the second requirement, the benefit test, arguing that the services are provided primarily for to control or to supervise the need for the need of the service provider itself, and it's not necessarily beneficial to the service recipient. Now, so it is therefore critical for service recipients to collect evidence or other supporting materials to prove benefits for each service category and document them as much as possible, as many as possible. But these collection of relevant evidence usually requires a lot of time and efforts. So we would recommend, or we do not recommend that you start this process right close to being audited. So you should have ample time before you actually prepare all the documents, at least a few months beforehand. Now, with the recent introduction of low value-added intergroup service scheme into legislations in various countries, taxpayers may want to look at whether the service provided fall under such category, so that they can qualify the safe harbor rule of 5% markup, so that that can certainly reduce the compliance burden for the company. Now, the audit teams tend to also challenge the deductibility of those service fees that were determined non-deductible during a previous audit. So knowing how much a tax assessment was made based on the prior audits, the taxpayers should take that as a parameter for upcoming audits and work out to reduce the amount as much as possible beforehand. The taxpayers also may want to, prior to a tax audit, closely look at the intergroup service charges to identify the items that are vulnerable to potential audit challenges. And some examples may include charges that have drastically increased despite in appearance there had been no, for example, changes in the business or functional profile of the company, or in the services that seems lacking benefits to the service recipients, services that are beneficial but lacks evidence to support its benefits, and sometimes there are service agreements without signature, or service agreements which has a huge gap between the actual contractual date signed and the actual service delivery date. So these are the areas that you may want to look at and then make sure that you have all this handy and ready before an audit. Once the weak areas are identified, obviously it is important that the taxpayer should take necessary measures to mitigate the tax transfer pricing risk prior to the audit. With that, I hand over back to Sam.
Thank you, Chris. And so just to recap and pull together some of the key points from our lessons across APAC, the stakeholder management or input is often one of from the closest, being in the tax department, i.e. indirect tax, is important in the early setup and or part of a revisit of intercompany service models. From India, but applicable across the region, more effort should be made to categorize and frame the not so low value added services distinct from the low value added services. We find that the not so low value added services, whether we call them high value is a question, are typically easier to argue as being closer to the business, either core or at least closer to the business and distinct from general admin type of services. Benefit tracking and analysis for APAC is a measure of thumb. We would say that, where folks have historically spent 80%, let's call it 80% of their time on factual TP analysis and most of that on functional analysis and less than 20%, let's call it, on benefit tracking. We think that it's important to balance that out. It may be going too far to say that should completely shift, but we know as a fact that the tax authorities and the regulatory administrators are more focused on the benefit tracking than they are on the functional descriptions of the service recipient. I think that's been proven through even before the OECD work 5 years ago, and it continues to be true now. Finally, to take stock of vulnerabilities in tougher jurisdictions and to improve your second line of defense, i.e. your audit defense files, and to improve operations in advance of actual audits is a key based on some of the messages that Chris provided us. And so, thank you. That brings us to an end of our discussion today. I think we do have a few questions from the audience that maybe we can try to respond to, and maybe one is noting we've talked a lot about a lot of jurisdictions, but we didn't mention Hong Kong and with the changes, the TP changes in Hong Kong and the significance of regional headquarters in Hong Kong. Is there anything of note there? Maybe I can hand that question over to you, John. I know you're maybe involved and close to that market in particular.
Sure, Sam. So Hong Kong is on the other side of a lot of these transactions. We often find, especially with regional headquarters. And after the TP rules were brought in, it has put much more emphasis on actually looking at what costs are being charged into Hong Kong and whether these are all being charged out. And so I think there is sort of that, a lot of, as we've been talking about, a lot of trade-off in terms of people absorbing costs in Hong Kong potentially and not pushing it out to where the other countries are, and having better support around the benefit test and actually the benefits that are provided centrally is quite important. And we do expect there is going to be more scrutiny of this area in the future, especially as services are a really embedded part of global business now. And Hong Kong is obviously going to be looking much more closely at the TP arrangements in the future.
Thank you, John. That's helpful. And that, unfortunately, is all we have time for. Chris, Anishi, John, and Versang, thank you. And special thanks to all of you who were able to join us. We would like to encourage you to fill out a short survey that will pop up on your screen momentarily and tell us what you thought about today's program. If you joined us late, please note that this presentation will be archived for future viewing. If you feel that others would benefit from the webcast, please share the webcast via share this icon and have them visit the debriefs website. We will respond to all the questions submitted during the webcast in the coming weeks. If you think of any other questions or comments later, please feel free to reach out to either me or our speakers. We'd be more than happy to have a conversation with you. We also encourage you to participate in the Asia Pacific Tax Complexity Survey and share with us your views on the level of tax complexity in the current and anticipated tax environments in Asia Pacific. The survey is open until the 29th of January, and the link is available in the download and links box. And please don't forget to tune in to our next scheduled special edition webcast on the 2nd of February titled India Budget 2021, Facing the Headwinds. En masse, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax Webcast today. Goodbye.